Hi, Alvaro. Welcome to Venture with Grace today.
No, thank you, Grace. Thank you for your invitation. It's a great privilege to be here with you, and looking forward to our conversation.
Amazing. So to give the audience a little bit of background of Alvaro, he is a co-founder and managing partner of IGNIA, and IGNIA invests in world-class tech entrepreneurs solving problems facing by the emerging middle class in Latin America. And you led investments in a lot of amazing companies. To give the audience, and then you're also currently teaching at Harvard Business School. To start with the show, I would love for the audience to learn more about, how you got started from, your big corporation job as a CFO of a public company to where you are today.
Well, I mean, I'm not sure I'm an example of a typical career path, because my career has had lots of twists and turns, and in response to a lot of coincidences, and no, not by design. So the first thing I would say for your audience is, people tend to over engineer or over design their career path, and I recently read an article that said, don't design your career path, design your career portfolio. And yeah, don't try to over engineer, because life has a lot of amazing surprises, and you should be, if you try to over engineer your career, you won't be open to those amazing surprises and opportunities that life brings. Because if you over engineer it, you're like, well, this wasn't part of my plan, so I'm not going to do it. And I don't think I would recommend for people to be much more open to that. Having said that, and answering your question, so for me, the basis of my career is my rowing career. My school is in life and in my professionally is what I learned in sports. But more specifically, so talking about surprises about life. So when I graduated from my MBA, I couldn't find a job, and I won't go into too much of the specifics, but we had to stay in Boston for a year because my wife had a year to go in her studies, and the only job that I could find was in a microfinance non-for-profit in Boston. I didn't want a job in a non-for-profit. I had never thought about working for a non-for-profit. I didn't have a social impact minded view of things, but it was a job. And this a non-for-profit which is called ACCION International, which continues to be a big leader in microfinance and financial inclusion around the world. And a job that I didn't want, that I just took because it was a job, and just completely transformed my life. My boss there was Michael Chu, who has been is my partner at IGNIA, my co-founder. We co-founded together. He's the godfather of my children. He's been a great mentor of mine for many years. So and it got me into the world of financial inclusion, which has been one of my life passions and continue to be deeply involved. Right now, I'm sitting in the offices of Gentera and Compartamos, which is the largest microfinance institution in the Americas. We serve 5 million clients, and have been very involved with them for about 30 years. And so then I went to work at in investment banking in New York. I guess at some point we'll have to do one job like that, which is where I learned. That's where I learned to work, to actually have a discipline of getting things done day by day in your work. And there, a client hired me to start telecom wireless company in Mexico. That's where I lost all my hair. It was a huge roller coaster to get the company started. We had to raise $1 billion, which we're talking about 1998. So 1998 in Mexico, it was just an amount which it seemed similar to now Sam Altman saying that he needs $7 trillion. So that's how it felt. And then to try to raise $1 billion. And then I was asked to go. That's where I started my corporate life, because I was this was part of a big group which wanted to start the telecom division. But then I was moved to the retail and consumer finance division, where that division was a New York Stock Exchange publicly traded company. I was CFO of that, and that was my school on management. And that's where I learned to manage teams, to prioritize, to focus on what's important. So that was an incredible experience. Then I went on to be CEO of what at the time was the largest drugstore chain in Latin America. That was an amazing experience. It was a turnaround experience, and that's where I learned to lead teams. And then I went on to serve as CFO of what at the time was the largest glass manufacturer in Latin America. A completely different industry. It was a complete turnaround story, and I guess that's where I learned what I think is one of my superpowers, which is to get things done, and that's where I proved to myself that I could get things done. And then corporate life wasn't for me anymore, so that's where when I co-founded 17 years ago the IGNIA together with Michael, and it's been an amazing journey for the past 17 years leading IGNIA.
Totally. I wonder what were the lessons that you've took from running a, big corporation to venture capital?
I thought there were a lot lessons for me from the corporate world to work with entrepreneurs, and I learned the hard way that there is absolutely nothing that I learned from the corporate world that was useful with working with startups and with entrepreneurs. I had to literally press delete to my whole hard drive of all my knowledge from the corporate world to be able to work with entrepreneurs. It's a very, very different game. And I'm sorry I call it a game, because it's not a game. It's serious. But and the way I describe it is, when you are in the corporate world, when you're an executive in the corporate world, you are a Formula One race car driver, right? And you can be the best Formula One race car driver. You can be Max Verstappen and be really good at what you do. That doesn't mean that you're going to be good at other types of race car driving, like rallies, for example, right? It's also a car. It also has an engine. And not only that, a combustion engine. It also has 4 wheels. It also has a steering wheel. It also has an accelerator. It also has a brake. But it's a completely different ballgame. And I learned that the hard way. So my lessons from the corporate world were completely useless for venture capital.
I wonder, so when you guys first started the investing cross-border, like in terms of like fundraising back in time, you mentioned like before you fundraising for your fund, you guys were fundraising for like $1 billion for something else. I wonder how did you kind of like started your fund in the first place? And when it comes to fundraising, like how did things change from 17 years ago to compared to like now? And also like when you I'll save the second question for later.
Yeah. So I mean, yes, one of the reasons why I thought I could start a fund, and again, we could get into the reasons why I left the corporate world. I wanted to wanted to start a VC fund, which, by the way, we were the first VC fund in Mexico. So it wasn't like we were following the example of anybody locally. And by the way, there was nobody to learn from. People don't believe me that when I started IGNIA, I didn't know what a GP and LP was. But one of the reasons why I thought I could start a fund was because, yes, I had done lots of fundraising in my previous jobs, and I thought I could translate that knowledge to try to raise a fund. But it was a very, very different world then. And then we basically only raised funds from development financial institutions for more philanthropic type of sources, and 100%, not 100%, but 90% from either the US or Europe. And 17 years later, today, 90% of our capital comes from pension funds in Mexico. Now, 17 years ago, pension funds, forget about, did not invest in this type of asset class. We're not allowed to invest in this type of asset class. So now we are very fortunate to have amazing investors from the pension funds in Mexico. Those that have invested, one has to commend them because they've been very, very much visionaries, because again, we were the first VC fund to raise funds from the local pension funds. So for them, it was, they were willing to take that step to be the first pension fund to invest in VC. And so kudos to them to be leaders in making that first step. So very, very different environment to raise a fund then and now.
I guess if you're starting to raise a fund today, I guess like what were 3 things that you would do to get things started? And then why do you feel like people, well, obviously you are very senior executive at a public company. So I think raising funding for you, it's because of you kind of like already had the track record. But I guess like when you are thinking about, I guess like how do you get the ball rolling? And then what do you think are people's motivation to invest, besides like, trust that like you will generate a lot of great financial returns and stuff? And then how do you kind of like prove that without a existing track record in the venture investing space?
Right. So obviously this conversation is very relevant today in an environment where fundraising is tremendously difficult. So, I mean, I guess you're asking me a little bit, what should that playbook be? So first of all, I would recommend, first and foremost, you need a co-founder. You need a partner. Now that sounds easy, but it's not. And one of the reasons why it's not easy is because obviously somebody that you respect, that you trust, but at the same time, it's not the best idea for it to be a best friend or a family member. So how do you find somebody that is not a best friend, that is not a family member, but you respect and trust, right? Then it has to be somebody who's complementary to you. Because if it's exactly the same to you, then it's not adding anything. And that is completely counterintuitive, because by nature, we tend to hang around with people who are similar to us. And I tend to say to my students, gorillas hang out with gorillas. And you don't see in the jungle, a gorilla hanging out with an elephant, because it is against nature, right? So when you're trying to find somebody who's complementary to you, it's completely against your nature. And because by definition, it's somebody that's going to look at things differently, is going to have different opinions, is going to have different solutions to the problems, and that's not easy. We tend to hang around with people who are similar to us, and obviously there needs to be a sync in terms of values, but that's one thing. But then there needs to be capabilities and strengths, and what you're good at needs to be complementary. The second thing that I would say in terms of this playbook is people invest in people. People don't invest in projects. So never forget that. When you're doing fundraising, they are the most important decision is this someone that I think he and she can do it? Is this someone who I think has the capability? So the very good investors, they usually, there are three people that you're pitching to, right? And one of them, usually the most junior person, is checking out if the numbers jive, if what you're telling them in terms of numbers, etc., if the actual numbers are working out. The second person that tends to be the second most senior person is thinking about, does the strategy work? Does the strategy jive or not? And the most senior person will be evaluating you. Do I trust this person? Does this person have what it takes? So at the end of the day, the most senior person is thinking about you, not your strategy, not your numbers, is thinking about you. So never forget that, right? So how do you make that human connection? How do you connect with your audience at a different level, not just on the rational level, right? And with that, obviously, how do you get the third thing that I would say, and related to this second part, how do I get them excited about what we're doing, right? And many times this is very reptilian, right? We tend to be very rational in our pitches, but at the end of the day, what's the element that gets them excited of what we're doing, etc., right? Now, in terms of track record, I mean, I would say it's practically impossible to raise a fund without a track record. So, if you've been an angel investor, how have those investments performed, right? So that's track record, right? You might be having X job, but on the side you're doing some angel investments. So how have those done? So you do need to show some track record. Obviously, an obvious one that a lot of new founders of funds is, people that are maybe at the principal level at a fund, and then decide to go on their own. So, what's your track record as a principal in a fund, right? If you've been an entrepreneur, obviously, what's your track record in terms of results, in terms of what you've achieved? Why do you have a particular angle towards investing? Being a good entrepreneur doesn't mean you're a good investor. So how do you translate that? And you need to be very clear on that. And so that's a little bit of a playbook that I would recommend.
I wonder, I really like what you said about, like, you kind of like you have to find a co-founder. Number one is like, I know that you found your co-founder from work, but if a lot of people are nowadays, like, fundraising are like fairly young, and then they didn't really have, like, I think it's really hard to find a coworker who will do exactly the thing that you want to do. And without that, how do you quickly build trust with that person? And another question is like, you know, you mentioned about like track record. I think venture is somewhat like a numbers game, and without like a lot of testing, it's really hard to find like what will work. And then as like, even if you're like angel investing or something, but on your own, um like most, since you teach at Harvard Business School, like I'm sure like a lot of your students are like angel investor themselves, like, but um I'm sure like not everyone has like $1 million sitting in the bank to just deploy, right? So I wonder, what's a way that you would approach it from, you know, like your student or like your mentees like perspective?
Yeah. So I mean, there are a lot of things that you're asking. So let's try to go one step at a time. So your first point was, you know, how do you do it when you're young, et cetera, et cetera. I get that. Um, the first thing that I would say is be patient.
Mm,
Um, um, and and I know it sounds like BS when I say it, because um, I climbed the ranks of the corporate world very fast and very young. So I'm sure your listeners are saying, yeah, for you it's easy to say. You know, you were New York Stock Exchange a public trade company CFO when you were 30, right? So yeah, sure, right. And it wasn't the right thing to do. Having done it, it wasn't the right thing to do. So so just, I mean, things in life, there's a wisdom that sometimes you need to be respectful of, and there's a reason for that wisdom of why experience is needed to do certain jobs. And many times it's that wisdom is not because you need the wisdom to do those jobs. Many decisions that we make in business are relatively trivial,
mm,
and it's more that you need to have the emotional maturity
mhm,
and to do certain jobs, and especially to go through certain dire straits and to receive certain blows that will happen. There will be cloudy days, that I can
mhm,
assure you. And in order for those cloudy days not to be traumatic, you have to have the emotional maturity. So, you know, just don't try to hack that process.
mhm,
So, and this is not a speed race. Don't get into the rat race that you are gonna reach certain positions sooner than your peers. Please don't get into that. It really doesn't bring anything good. And now, uh, um, one of going to the second part of your question, one of the really difficult things about VC is that the feedback loops are really long,
mm,
right? I mean, I don't know how good of an investment I've made until in a, you know, 5, 7, even 10-year period, right?
mhm,
So, I mean, those are really, really long
mm,
feedback loops, right? And that is completely different from almost every other um, uh, business vertical that you can get into, right? If you're
mm,
selling a product, pretty much you know if if there's demand for the product, and if you're running a big company, you pretty much relatively quickly if you're getting the right results, et cetera, et cetera. So, and because of these very long feedback loops, and it takes a long time to develop that track record, right? Now, the last part of your question is, not everybody has $1 million lying around to make. I think where you were alluding to is like angel investment, so that you can create an angel investment portfolio, so that you can show your track record, right? It's easy to say, no question. I mean, that is a very fair point. By the way, I didn't have that privilege. I didn't have $1 million lying around to make angel investments. So I very much sympathized with your with your point. And that's why, working at a VC fund to get to a principal position, you don't have to have $1 million. You create your track record with investments that you made as a professional, not as an angel investor. Right? At the same time, you can raise. I mean, right now I'm advising 2 students who are raising a pre-seed fund, right? And it's a $750,000 pre-seed fund, and they are pulling from people that trust them, etc., etc. And they're not gonna be able to make a living out of a $750,000 pre-seed fund, but they are gonna be able to build a track record, right? So that's also definitely an alternative, right? You can you can do that. And the last part is you can invest $10,000 in 5 companies, right? I mean, and that's $50,000. It's still a lot of money. Not everybody has $50,000, especially if you're young and you're still paying, student debt, etc., etc. So I'm not. Believe me, I don't live in a bubble that just $50,000. And I'm very much conscious that it's still a lot of money, right? But let's just put things in perspective. You don't have to have $1 million to be able to do this. With $50,000, you can start doing a little bit of that.
I wonder what was your, I guess, like when you first started your fund, how did you come up with the investment thesis? And obviously, like in a hindsight, right now, Latin America has been like the market has been growing, and then there's a lot of like unicorns coming out of the space. I wonder, like, how do you come up with your thesis, and then like what was your investing strategy on coming up with like a pipeline that's repeatable to hit the top founders in the space?
Yep. So I'm going to repeat myself what I said earlier, which is we had no idea what we were doing when we started. Our investment thesis was very much in the backs of our experience in microfinance. So there is no coincidence. It is no coincidence, sorry, that IGNIA was founded in 2007, because the IPO of at the time named Compartamos continues to be the commercial name, but now the group is called Gentera, which again where I'm sitting at, and it was the year that it did its IPO, and it was 2007. Investors, early stage investors that invested in Compartamos in 2000, which is when we raised $6 million from investors. Those investors made a 250x return at the time of the IPO. So, I don't know what's your research about good returns in VC, but 250 times it ain't bad, to say the least. So I by the way, I was never an investor, and that's a long story, but because I came through a non-for-profit, etc., etc. But it was that it was a big eye opener that it was possible to create significant returns by serving the base of the socioeconomic pyramid with a product or service that had a very positive impact on the lives of those being served. So that was our initial vision, right? It's like, wow, it's possible. There's so many things that this segment of the population is underserved. Again, we had experience in financial services, but there's health services, and there's housing services, and there's et cetera, and that there is a possibility to do exactly the same, serve them, help them improve their quality of life, and have extraordinary returns. So that was the initial vision. It turned out to be way more difficult than it sounds.
Mm-hmm.
And then, and many times it's not only that our investment thesis evolved, but our ecosystem evolved. You know, at the time there wasn't other funds, so there was nobody that you could co-invest with. It's a very different investment thesis when you can co-invest, right? There were no tech entrepreneurs. Now in Latin America is flooded by incredibly talented tech entrepreneurs. So that was so the thesis has evolved very much in line with how the market has evolved around us, right? And at the same time, for us, a big element of our investment thesis is we look at entrepreneurs from outside of the region that want to come into the region. The region is tremendously attractive as a market. We are, we have one of the youngest populations in the world, and average age is 31 years old, when, for example, China is 40 years old, and India is 28. Second, we have the highest internet penetration or digitization in the world after US and Europe, significantly above, again, for example, India. I mean, India has about a 50% penetration. We have about a 75% penetration. We have a very high purchasing power. We are the emerging market with the highest purchasing power in the world. Again, compared to India, our income per capita is about 5 times India. So there are a lot of elements that are very, very attractive, and they're very attractive for local entrepreneurs and very attractive for entrepreneurs from outside of the region that want to serve this market. That is one of their strategies, is to expand into this market. But obviously, when they want to come into this market, they need help. They need every single market. You need to learn how to navigate it, and that's a lot of our strategy. To invest in entrepreneurs from outside of the region that want to come into the region. That has given us the ability to get into very, very contested cap tables, because name whichever one you want to name, but the best funds in the world, or the most well-known funds in the world, not sometimes the best, don't have that value. They don't have expertise about Latin America. And when an entrepreneur sees that Latin America is a key market for them, they say, I want them, because they're going to help me get into that region. Which gets me to the last point of your question, which is, how do we source that pipeline? So one of the big fallacies in this business is that you can be better than others at selecting the right entrepreneurs, the right projects, etc., etc. There's one question that is very important for you to have, clarity on what are the mega trends that you believe in, right? So, and yes, there are some that are better at doing that than others. But once you do that, the data shows, especially in early stage, that VCs are very bad at selecting. So there's a fundamental reason for that. It's because in early stage, the information asymmetry is huge. There are so few data points for you to be able to make the decision. So you need to be careful and think, I can select much better than others. So where's the trick? The trick is not so much that I become better than others at selecting. The trick is to developing a reputation that you can bring such strong value add that the best entrepreneurs pick you. You don't pick them, they pick you. That is the real trick. Now, if you want, we can get into the conversation of what does value add mean, right? Which is also important. But so you need to figure out how you can add value so that entrepreneurs really see your value, so that entrepreneurs talk about with each other, and eventually say, one is raising and talks to another one and says, I want an investor that can help me. And they say, you need X or Y because that's exactly what you need. The best entrepreneurs don't only look for a check. The best entrepreneurs look to see who are going to be companions in their journey and are going to really help them on that. And when you're able to develop that reputation, then your probabilities of success in this business are much higher.
I wonder, like, when you're thinking about build that reputation, let's say there's 3 scenario that kind of like come up into my mind, right? Like, one is, let's say you invest in a company, this company succeed, obviously, and then if you like contribute a significant amount of value, that's amazing. But there is also the part that, for example, you invest in company X and company X went just like tanked. And sure, the entrepreneur will be like, oh yeah, like this fund is like super helpful, but like the company died. So like it's like a really bad result for you. So I wonder, like, how do you deal with that situation? And then number 3 is like, sure, you help a lot, but like the founder or like the founder and the fund doesn't really fit. Like, let's say they want help with X, but like you can provide help with Y, and like it didn't really end up being the best fit, even you contribute a lot of effort. And I wonder, like, how do you deal with these kind of situations? And then also, like, for example, I feel like adding value is kind of like a long-term game. Like, you can't really like build a reputation within like a day or so. Like, although you mentioned like being patient is like a very, very important thing. But I wonder, like, how do you quickly build up that reputation, as like you need to attract the best entrepreneur from day one?
Yeah. So I'm starting to see that you like to ask very loaded questions.
I'm sorry.
So
I
no,
I wrote
it's
down
okay.
I wrote down these
It's
like on
okay.
a Kanban board.
It's
So I
perfect.
like, while you were talking, I'm like typing. So
It's perfectly fine. That's perfectly fine. So I mean, it's exactly, let's get into what I mentioned earlier, that we can get into what value added means. So right now, the perception in the market is that value added is, well, in our team, we have one of our partners that is an expert in marketing. So they're going to help you entrepreneur, company in our portfolio. We're going to help you in your marketing strategy, right?
Mhm.
And that's fine. That's perfectly fine and wonderful. But I don't think that's the best value add. Being entrepreneur is a very lonely journey, right? And many times the best value is just to be a companion in their journey. Now, what does this mean? That's like a very nice headline, right? But what does it mean? First of all, to and it goes related, by the way, with what you said. What happens if one of your companies tanked? First of all, you need to develop the trust in the relationship, that they feel comfortable in having a completely transparent conversation with you, right? And they are not scared at telling you, these things are not working out, and that you are not going to be judgmental on when they are completely open with you. And it takes some time to develop that trust relationship. Once you have that trust relationship, the first thing that they need to feel very comfortable is that when they are going to come with you with a problem, you're not going to get scared. And you have no idea how many investors get scared or cry foul or say, how could this happen, etc. Right? So instead, when they because we all make mistakes. We all make mistakes. And so when they come with you, I said, look, I screwed up on this one. And your reaction is going to be, okay, what did you learn from it? And how can I help? Right? And related to what's value add, when we say, I have the marketing expert that's going to help you, the underlying assumption behind there is that this person has the answers for you. And you need to be very conscious that when you're making an investment, again, related to what I said earlier, that people make investments in people. You're making an investment in a team because you think they are the best suited to tackle that problem. So if they are the best suited to tackle that problem, they have the answers, not you. So what is it you bring? You bring the questions. So it's how do you help them think through their problems? How do you help them, have a conversation of, oh my God, I hadn't seen it from that perspective. I hadn't, so it's the most important part is, again, develop the trust, have an open conversation. And when you're having an open conversation, it's much more bringing the questions rather than the answers, right? That is the real value add, right? When an entrepreneur says, you have no idea how much this investor helped me think through this problem. Not, you have no idea how this investor helped me with, whatever answer, right? Now, related to the point of when investment tanked, let's never forget that this is a high-risk business. The hard data tells us that 80%, 80, of startup investments fail. So what is the definition of failure for this number? Is startups that were not able to return their capital to investors. Some of them return 99 cents out of 100. Some return 0. But under that definition, 80% fail, right? So I have news for you. You're going to have a lot of failure in your portfolio. So it's part of the business. So you can't. Your track record is not how many times you failed, but which ones were successful. And obviously, one of the biggest decisions. I mean, one of the toughest things in this business is, oh my God, we have to continue funding this company, otherwise it's going to fail. Don't be scared about failure. If you're scared about failure, you shouldn't do this. You just shouldn't do this. You should be perfectly okay with a company in your portfolio from failing. Perfectly okay.
But what about when you're considering about the LPs, you have to build some sort of a diverse portfolio that something have to succeed, right? So especially for first time fund managers or let's say your first 3 funds, you're supposed to actually have something going on to a degree. So I wonder to get something going on, I hope you're okay. Okay.
Yeah, I'm fine.
I wonder if you have let's say in your first 3 funds, there's no unicorn or there's not semi-unicorn or let's say half of your portfolio are successfully raising the next round or something, or some other indicators to prove that the investment thesis is working out. How would you go about continuing or not continuing? And I guess since you have so many years of experience that you have went through this a long time ago, and I wonder based on your observation from either operating your own fund or looking at peers, I wonder what do you see as a pattern for the successful fund versus people who were not making it?
So first of all, that we need to be very careful about this what's the word I'm looking for? This adoration that we have towards unicorns, right? Because the average unicorn is a 3 times or 3x return. Okay. And the average unicorn raises about $300 million. So 3x return is not, I mean, it's not bad, but it's not something to write home about, right? And we can get into that, the dynamics that happened in the last few years of investors just shoving money into the throats of entrepreneurs, and why is that, etc., right? So let's just put that in perspective. We need to be very careful with that adoration of unicorns. I mean, we're here to produce returns for our investors. I always say our reason to exist is entrepreneurs. Our responsibility are our investors, right? Now, your point is, how do you, if you don't have something which has produced significant returns over your portfolio, what can you show as signs of progress that you are actually, in the right track? And for early stage investors, no question, is, for example, if you're a seed fund investor, so what percentage of your portfolio was able to raise a Series A, right? And that is a very important metric, right? Because that means that the companies that you've invested in at least are making progress. Traditionally, I mean, a rule of thumb is that to raise a Series A, you will have had to have reached a product market fit. So that means that you've invested in companies that the team was strong enough that they were able to reach product market fit in the majority of the cases. So that's definitely a good sign of progress. And because, as we said, this feedback loops are so long that it's difficult, right? And we don't have the privilege that most funds in the US have, which you can raise a fund every 2 or 3 years, right? We don't. We live in a very different environment of LPs. They like to wait much longer to see that success in order for them to be able to invest again. So it's a very different world where we live in, and as of today, basically very little. I mean, very marginal institutional investors in the US will invest in funds in Latin America. They will invest in funds in the US that invest in Latin America. And that's another discussion of why is it they do that, and if it makes sense or not. But most of the money invested in Latin America, in VC, comes from investors sitting in the US making investments into Latin America.
When you are looking at, like, how would that shape your investing strategy differently versus like the people who are sitting from the US but investing in Latin America, and versus like you guys are helping these companies to basically the go-to market in Latin America, right? So I wonder, like, also, like, can you walk us through one of your portfolio, maybe Abra or like Rapyd or anyone that you feel like you're comfortable talking about? Like, I would love to learn more about, like, from you meet them to why you feel like they would be a good fit, and then how you add value and all that.
Yeah, no question. Well, I'll go directly into, for example, the example of Rapyd, which addresses your point of our investment strategy, right? So, so they actually, going back to the point that the best entrepreneurs find you don't find them. So they came to us, and they said, we've done our research. We need a Latin American investor because Latin America is going to be a key region for us, and we'd like your help on that. So we'd love for you to invest in our company. And we did our diligence. and the business model that they had when we invested is completely different than the business model that they have today, which goes to a very important element: is you're investing in a team, and we really like the team. If there were serial entrepreneurs, Arik Stillman, who's one of the co-founders and the CEO, tremendously strong and entrepreneur. I mean, in all fronts, right? And so we really like the team, and talking about mega trends, we really like payments, especially payments means a million things. We very much liked companies that were trying to solve a lot of the bottlenecks that exist, and especially in cross-border payments, but in general in payments. So Rapyd is not a consumer payments company; it's trying to solve solutions for companies in their payments needs, right? So when we invested, they had zero sales in Latin America. When we invested, the company was selling about $3 million. And today, 20% of their sales are in Latin America, and their total sales are about 500 million, right? Now, we co-invested with huge investors like, General Catalyst, Quatu, right? So, if Arik was sitting here with us, he would confirm this story, because I actually heard it from him. Is that when they were, closing the deal and putting together the cap table, these huge investors were like, "Why do we need these guys? I mean, we don't need these IGNIA guys. We can close the deal without them." And the CEO said, "No, you don't understand. We need them for our Latin America strategy." Because, with all due respect to General Catalyst, who are amazing and they're close friends, and I respect them and admire them tremendously. Also, Quatu, know the founder, Philippe, for 40 years. Incredible guy, one of the smartest people you will ever meet. They're amazing, but they don't know Latin America. So they can't bring that value out, right? So that's it. Again, we have a mega trend, which we like. We have a value add that entrepreneurs appreciate. They come to us. We see a tremendously strong team, and that makes sense for our portfolio. It makes sense, and it's been a tremendously positive investment for us.
I wonder, since you left Latin America for like a long time, since like the HBS era, I believe, and then maybe like you went back and forth or something, like, because I know that you also work at as like a board member of this other company and everything. So I wonder, like since the era of like you started the fund, I wonder, how do you spend your time between like LATAM to the US, and how do you maintain the relationship? Because 17 years of like starting this fund is a long time, and like I wonder, how do you keep the relationship fresh to keep the go-to-market strategy for these companies like strong? And when I've worked cross-border in like different companies, and then from my experiences, there's a lot of culture differences, and like the go-to-market strategy is very like interesting, intricate, like just overall interesting. And I wonder how, like, and then for each company is also even more different, because let's say, like, I know you invest in the fintech sector, but like when you're thinking about like the future of retail, SaaS, marketplace, like there's so many different sectors. But like I personally don't know how to build a relationship in each different sector to be helpful for the portfolio company, to kind of like help them with like specific things or people they need.
Yeah. So I mean, yes, I do spend a lot of time, not only maintaining but developing relationships in the region with different actors, and that is one-on-one, having conversations, etc., right? And And that is one of the things that I do well, which is having strong, wide net of relationships. Now, again, I don't define the go-to-market strategy. The best suited to do that is are the entrepreneurs, but I facilitate the go-to-market strategy. So they come to me with, for example, we recently invested in a company based in San Francisco that is entering into the cross-border payments business for SMEs. This entrepreneur who's amazing, but doesn't know Mexico, right? So, we sit down, we talk about the strategy. He wants to get to know the market better. So I make a list of people that he needs to sit down with to get a very good sense of the market, right? And then he'll come with the answers, but I open the door to all these meetings, and it would take him maybe years to be able to put together the roster of people to sit down and talk and get the fine understanding of the market, right? What are the little things that you need to be careful on? And each market has those things, right? But with my help, it's a hack. He literally can get those type of meetings in a week, right? So I'm not defining the go-to-market strategy. I'm just facilitating and open the doors for him in this case, to figure it
out. How do you keep the relationship warm?
I mean, look, a hack that I've had all my life is I every day, the first thing I do is I congratulate 5 or 10 people every day for their birthdays, right? And if there's somebody that you haven't talked to for 10 years, but in the past 10 years, every year, and you've congratulated them for their birthday, and one day you call, they'll pick up. And if they haven't heard from you for 10 years, then maybe they won't pick up, right? And so that's a hack that I recommend, right? And then I have a very disciplined system, which I have specific relationships that I want to maintain. And for example, yesterday I had lunch with an entrepreneur who's not part of our portfolio, but it's an entrepreneur that I very much respect. That I learned a lot from him, and we had lunch yesterday. We had a wonderful conversation. I pick his brain, and what are the trends that you're seeing? What are the opportunities that you're seeing? And obviously, he's very much involved in his business, but entrepreneurs because are very good at seeing where the opportunities are, right? So and then I make a note in my reminders in a year's time to call him to have lunch. And that's been going on now for a few years. And every time we sit down, we have a wonderful presentation about life, about many things, but also about, I learned one of the privileges about this business is I learned so much from all these entrepreneurs. And it's simply a gift to be able to get all those lessons from these incredible individuals. And so you just have to be disciplined on it.
Totally. I really like that we're getting very tactic here. By the way, when is your birthday? I need to make that put that on my calendar thing.
I'll tell you in private.
In the chat. Okay, perfect. Okay, so we're at the last part of the interview. I have a 1-minute fire round for you.
1 minute?
Yeah, 1 minute fire round. Okay. What's your favorite book?
Okay. My favorite book is a book that I can't remember the author, but
Alvaro, it's 1 minute. I'm just kidding. Okay.
It's a infinite story, and it's the infinite story. Anyway,
who would you invite to your dinner party?
who
would you invite to your dinner party?
Alive or dead?
It's your party.
Well, Nelson Mandela.
Who made the biggest impact in your career?
My mother.
Where can we find you outside of work?
Where can you find me? Outside of work?
Outside of work, yeah.
Rowing.
Okay, amazing. We're done. Wow, that's literally 1 minute for Aaron. I like that you just keep everything into like one word. But thank you so much for coming on to the show today.
Great. No, thank you very much for your invitation. Great conversation, and thanks for everybody that is listening. And good luck with everyone, because good luck is you make your luck.
Oh my God.
It's also sitting at the table. So good fortune to everybody. Thank you very much.